Hi, I am Nikolai Barnwell. I am the CEO of PawaPay.
Welcome to the African Tech Roundup, Nikolai.
Thank you. I'm very happy to be here.
Fantastic. So, fintech, an evergreen buzzword in our tech ecosystem here in Africa. You have a background in the betting industry, which is something really interesting I'd like to touch on as our conversation unpacks. But you're now in a space that is proliferated by a number of fintechs with we want to be banks now aspirations. In Europe, obviously, we have the likes of Revolut leading the charge on perhaps a playbook, a global playbook for what that can look like for a range of players on the African continent. We obviously have a unicorn or two on the continent that are posturing to that effect. In a world that is driven by that as a contextual backdrop, how do you frame PawaPay's aspirations in the space? In what ways do you lean into that mainstream narrative ambition? In what ways do you depart from it?
What we're trying to do at its core is that when you look at the business on the continent, it's still highly non-digital. Most transactions on the continent are cash. And when you look at the kind of journey that Stripe went on about a decade ago of trying to bring and grow the global digital economy, we kind of narrowed that a bit in, and we want to try and grow the digital economy on the continent by making it possible for businesses to plug into the digital infrastructure that exists and make it possible for consumers to connect to the digital infrastructure and connect to businesses and buy services. That is what a lot of other fintechs are doing on the continent. What I think sets us aside is that it's a difficult problem to solve at scale, because if you're trying to help businesses that have true Pan-African ambitions, you need to be present in all the markets. You need to be present where people are in Senegal. You need to be present where people are in Zambia, where people are in Kenya. And that creates a bit of a problem, because if you're a payments company, you have very slim margins. So you really need volume. So what we saw on the continent was about 4 or 5 years ago, when the last big fintech boom was there, was that there was an opportunity. Because if you imagine you're a fintech in, say, Kenya, a payments company in Kenya, and you're trying to scale and you have Pan-African ambitions, you will never make enough money just with volume in Kenya to amass enough cash to build out across the continent and build a Pan-African footprint. So there's really only two ways to do it. You can either get a large Pan-African anchor customer that can help you generate cash flow to go across the continent, or you can do it with VC money. So this was what we saw in the last big fintech boom. A lot of people went out. There's a huge interest in payments in Africa, Flutterwave, Chippercash, etc. They got huge funding from outside that allowed them to build this Pan-African footprint. So you kind of see a split where you have a few large Pan-African companies that are truly serving multiple jurisdictions across the entire continent. And then you have lots of smaller local PSPs that are serving deep in Ghana or deep in Ivory Coast or deep in Zambia. So where we fit in that ecosystem is we're one of the few that really have a very broad, direct footprint. So we don't have any downstream partners. One of the keys for us is that it's important to own the technology for quality purposes. So we're directly integrated into all the wallets rather than hodgepodging together different solutions from different providers.
Okay, so that narrows it down nicely. It sounds like you seem to have had the privilege of being able to pick and choose how you'd be positioned and how you'd come to market and where you would fit within that ecosystem. Talk us through the journey to that positioning.
So it's maybe helpful to walk a bit through how we got here and what led us to go for this opportunity in the first place. So to do that, I'm going to walk you a little bit back in my personal history. I have been a Kenyan resident since 2009. I started out working for a investment fund in the early days in Kenya in 2011. It was an investment fund called 88 miles per hour. It was in Kenya, it was in South Africa, and then it had a footprint in Nigeria with 440. Like most of those kind of things, there's an enormous death rate. We did about 50 investments over 5 years, and most of those investments went absolutely nowhere. But the reason for it was a very particular time. It was the mobile money launched in 2007, so it was just on the rise in East Africa. The mobile internet, the rise of the smartphones also coincided just about those years. So there was this explosion of smartphones and mobile internet across the continent. And we saw that as an opportunity to invest and do a kind of Y Combinator model on the continent to invest in startups that were building for this explosion. And what was interesting about that explosion was where I'm from Denmark. When I grew up, we had lots of access to education and information and entertainment. The mobile internet was kind of a very gradual shift and a very gradual add-on. But what we saw first row in Kenya was that the introduction of these smartphones and the relatively cheap data price that followed quite soon after, suddenly people went from very poor access to education, entertainment, and information to having everything in your hand on like a $50 smartphone. And that demand pull was so intense, and we saw it grow so fast. It was, we went from massive satellites in our backyard with very poor downlink and almost no uplink to, in a matter of 2 years, all the journalists having Twitter handles at their bylines in the newspapers. And the pull was just so strong. So we saw that growth and invested in all these different companies. And through that, it gave us a first row seat to the development of both mobile money and of mobile internet across the continent.
And your role in that context?
I was just a program manager. I mean, I was fresh out of uni and had practically no experience, but I met a very cool Danish entrepreneur who took me under his wing and said like, hey, I need someone to help me do this. So we started building this out, and it gave us this front row access to see how the development of mobile money spread on the continent. And we started to seeing how all the businesses that we're touching through our investments, obviously, again, a big core problem is payments. How do you actually interact with your customers? And the traditional financial infrastructure was so broken. I mean, cards were practically, and still today, practically non-existent in most of these markets. So it was mostly all about mobile money. And then the interesting thing was we started seeing these developments in Kenya and how they're developing. And then we started seeing, in Uganda, in Tanzania, in Zambia, and how you could kind of phase shift it a little bit to the right and follow the same development. So we started noticing trends and patterns like, when there's about 1 million users in the ecosystem, this is what it looks like. Then we can start to predict that in 2 years, it will tend to look like this. It will tend to have this many users. It will tend to have this many use cases, etc. So we started developing this core belief in mobile money that basically boils down to, if you look at what the payments infrastructure will look like in 10 years on the continent, a lot of the macro trends are not very controversial bets. Like, there will be more people on the continent. I think most demographers in the world are pretty set on that. Even if the birth rates plummet to 2.1, just the sheer fact that the demographic is so young will mean that there will be added 1 or 2 billion people on the continent, just as the young population grows old and fills up the demographic pyramid. So there will be a lot more people. Generally, bar some kind of great global disaster, the continent will get richer, so there will be more people, they will have more money. Looking at trends across the rest of the world and how it will likely follow on the continent and how it has been going in the last 10 years, people will be more online, not less online. And the general shift will be from cash to digital transactions. So those are kind of like the basic trends that you look at in the financial world and the fintech world on the continent. So those are not very controversial. In the future, the digital payment space will be a lot bigger.
And these are thesis drivers from that era where your experience at that time, you came away with these thesis points.
Yeah, we saw that quite early. We saw just the demand pull for mobile money and for mobile internet, and we paired that on top of the macroeconomic trends of population and GDP growth, etc. And you come to this basic thesis that pie will be a lot bigger. Now, what's going to make up that pie? You have banks, obviously. They will take a big part of the digital transactions. And then what you have left is credit cards, and you have mobile money, and you have other wallets like PayPal, etc. And then recently you have crypto. So our kind of core bet and our driver with our thesis was, when we're looking at the speed of development with mobile money and the pace of adoption and the use cases across the continent, and we started noticing these trends growing from East Africa into South Africa and onto West Africa, we start to see what we think was a quite strong trajectory that mobile money would be the winning consumer payment method on the continent. We just simply didn't see any interest in card. Card is a technology from the 70s. It doesn't really fit that well into the modern financial infrastructure. It's shoehorned in mostly by legacy. And when you have a chance to leapfrog that technology and completely replace it with something better, we saw it quite unlikely that cards would take a share of that. So we looked into the future and said, we believe that mobile money will be a very dominant part of the digital transactions in the future. So why don't we build from the start a core payments infrastructure that spans the whole continent with the alternative financial infrastructure around mobile money as its core?
And so who's we? For anyone listening who's not familiar with who you partnered with, who your thought partners were at this time, and what that distilled into?
So this came out of the organization that we were in at the time, which was the betting company BetPower. We started building out BetPower as a part of BetPower at the time, and we started scaling that across the continent, going into new markets. And it quite early became obvious that if you want to scale this type of business or any similar kind of digital consumer business, the two big barriers to scaling are really licensing and the payments. Because when you go into a new market, the payments landscape is very different and complicated. And to be able to scale quick, you need to be able to roll out payments quick and effectively. So we started working with third parties mostly because as a betting company, as most businesses, payments isn't your core. So we would by far prefer to have a solid third party partner that we could just say, can you handle all our payments? Then we can focus on what we're good at in the betting industry.
And who was that at the time?
We used Celcom, we used Stripe, I think we used Pesapal for a moment, we used some Ugandan guys. We used whatever we could find in the different markets.
My question really is more in terms of that mix. Were you solving for bits that you needed pragmatically or things that you estimated you couldn't do yourselves?
At the very core of it is very simple. We had a betting company and we wanted our customers to be able to deposit money into their wallets and to pay them out when they won. So we were looking for somebody who could solve that problem for us. Is there anybody who can go and make all these integrations with all these telcos? Because it's very tedious, it's very difficult, the reconciliation, everything. Can we find someone who can just do that for us so we can focus on what we're good at as the betting company? We found a bunch of different partners and found the relationship wanting in most aspects. So at some point we started building it in-house. Mobile money is one of those things that at the surface is very simple and looks very easy, but the operational difficulties are really large. It's a highly fragmented technology stack, especially when you go into multiple countries with multiple MNOs. Even things like working with MTN in Uganda is not the same as working with MTN in Ghana. Like they sometimes run different versions of the stack and different integrations. They're trying to streamline it across the groups, but there are still large technical differences. Reconciliation, like a simple thing like, okay, so you make a payment, you get a confirmation SMS on your phone that you've paid, but if the reconciliation doesn't flow all the way through for missing API calls or whatever other technical issues that may arise, that payment might not reflect. And that's okay if you're doing 5 or 10 transactions a day. You can just fix them manually. You can call, you can go into the telco platform and look for the payment, etc. But when you're doing 5 million transactions a day, that's just not feasible. You have to have automatic reconciliation. You have to have a system that really works. At the core of it, mobile money is a quite specific beast. And if you have a company, like I'll take someone like Flutterwave, just to take a different example. Flutterwave does a lot of things, fintech. They do a lot of banking, they do a lot of cards, they do a lot of things. So for them, mobile money is just one little bit of their business. So there's like a head of mobile money in Flutterwave who sits and competes for resources with all the other departments in Flutterwave. So if it's only a tiny bit of your business and it's only a tiny bit of your revenue, you obviously can't pay the same attention than you can if you're a business that focuses 100% on that. So for us, the kind of last 10% that we really needed to be there, both in the technology here, I'm talking about the type of technology that will improve the success rates. Even if you're talking about improving the success rates from 73% to 78%, that's a huge difference if you're running huge volume. Have the resources to dedicate support. So if it's Saturday night and there are games ongoing and you really need the transactions to flow and there's something wrong, like you need to be able to call people and need to be on call and you need to be able to have technical resources to fix the problems. And if that's not the core of your business and you have many other things to do, understandably, you can't divert the attention and resources to fix those problems. So we found that maybe what we were doing was particularly high demand for some of these other businesses. And this is where something like betting actually is a little bit of the frontier. It's a little bit of an edge case on the frontier because it's very high volume, very low value transactions, very spiky around certain times of the day. So we didn't find anybody who had really doubled down on making mobile money work at very high volume, at very high attention to quality of success rates, and have a very big focus on support.
And it strikes me that your ideal customer profile within a betting context and the promise to deliver a utility for that customer, very, very different to someone like me, a diasporan, sending money to my family and the cycles that attend that, on a regular sort of monthly basis or...
Yeah, but it actually became kind of part of our core thesis because what we saw was the kind of demands that was coming from this particular industry on the mobile money ecosystem. We saw this is where everyone else will eventually be. The volumes will eventually pick up. Everybody will need a system that can handle the type of scale. Everybody will have the same requirements for the mobile money infrastructure as this particular industry has today. So if we build this for this industry now with those demands and the bar that high, we will put ourselves at an advantage when we go and the rest of the industries come eventually as the whole ecosystem grows. So that was like the core thesis of PawaPay, was to build with a very high bar and be ready for when the volumes across the continent grow.
So your baseline assumes Africa operating at scale to that baseline.
Yeah, we're thinking like, where is this in 10 years? We've been quite fortunate that we have almost no VC funding. We're mostly self-funded by the group of people who've been involved the whole time. So we don't have any short-term horizon that we need to run to. We don't have any demands from VCs that we need to build and sell and exit or hit certain targets or scale or do something at a certain pace. We've had the luxury of being able to constantly be like, we can think 10, 15 years out in the future. We can be in a slow, steady, long race. We've been profitable for a number of years now, so we don't have any restrictions of what we need to do. We can believe in the core thesis and kind of ride the wave. And of course, the core thesis has to be, I think, mobile money has to become the primary consumer payment driver on the continent.
Let's talk about that we. You've used we a lot. Who's a part of this wolf pack going from we were investing, now we're a betting company, now we're ready to be fintech alongside?
Yeah, I mean, it's a little bit of a long list of friend and family, but at its core, it's a group of individuals that centered around the entrepreneur I mentioned before who started the fund, whose name is Kristen. He came down and started the investment fund, and we're a small group of people who were working around him in the investment fund.
Wait, are we talking about 88 miles per hour or are we talking something else?
88 miles per hour. 88 miles per hour, initially invested in a small Ugandan sports betting company called Embed. Over the course of the first year and a half, the fund ended up buying out the existing shareholders of Embed and eventually turned it into BetPower. So BetPower is actually born out of the fund. So the fund, by some measures, is hugely successful because it had a stake in BetPower. We also started another company through there called Mdundo that ended up going public on Nasdaq's True North in Copenhagen. In that industry, we made 50 investments and I think 47 of them were more or less write-offs.
So you go from a fund that seems to have spawned quite substantial gains as far as being an ecosystem listening device for insights that then inform businesses you can launch and, by the sounds of it, run profitably, and then transition from that into betting. I'm on the record as absolutely loathing that industry.
You're not alone in that, I can tell you.
I'm sure I'm not. But I don't want to turn this into like a gripe about the industry, right? I do think there's things to be learned. What did you learn through that investment that suggested to you that, given those thesis points you started with, that betting would be a great place to build and leverage success into other things? Or was it as clear then as in hindsight or not?
No, I mean, that would be a huge lie to say that it was clear. We had many things that we all thought was going to make us tremendously rich that ended up going absolutely nowhere at the time. Betting was one of the ones that we felt somewhat confident about that was going to be an interesting business, but we had many other businesses in the portfolio that we had really high hopes of that ended up going south, as these things go. It's very hard on your emotions being an early stage investor because it's a massive roller coaster. You go up and down multiple times a day, and when you have a portfolio of 50 companies, that is multiplied by 50. So it's hard on the nerves. We didn't think betting particularly was going to be big. It was, and it took a long time. Like most of these things today, it's a very large, BetPower is today a very large company, but it compounds over many years. So like those kind of things, it happens slowly and then suddenly it compounds and 20% a year suddenly becomes really huge leaps forward. But even for BetPower, there are multiple times where we were sitting late at night pulling out our hair being like, oh, dude, should we try and find $60,000 more to put in? Should we keep it alive? What should we do here? Multiple times where it was very close to being shut down because we were just running out of steam and running out of energy, and there's a lot of things that were not working in the beginning, like most of these things. So it was not like something we from day one knew was going to grow to where it is today. That would be a lie. But it did show very healthy signs from the beginning. But the one thing that I think we did learn from being on the VC side from the beginning that I think was quite helpful also in the approach that we've taken now later to VC. I think VC definitely has a very critical role to play for building certain types of businesses and certain type of companies. And some VCs can be really instrumental for companies' success. But there are many vectors as well where a VC has the polar opposite interests than the company that they're founded. And there are many cases where taking VC funding is absolutely the wrong thing to do. And founders should be under no illusion that the VCs are in it for themselves and their own money. And the VC at its core is not interested in you succeeding. The VC is interested in you blowing up. And they would rather blow you up failing than you succeeding if succeeding doesn't mean blowing up. Because it doesn't work for VC if you become mildly successful and you double your business. So they need you to become a complete crazy outlier that 100,000 X's their investment. Otherwise, it has no interest for them. And that's not necessarily the interest as a founder. For most founders, if you can build a business and you can sell it for $1 million, man, that's a lot of money. That's a fantastic business to build. So it's definitely not always the right thing to take VC money.
And so in that sense, it's fair to call 88 miles per hour a failure, in that everything you described, in addition to the demand on those outcomes being linked to very specific horizons, right, that don't map neatly often for most businesses, that can take 10, 15, sometimes 20 years to actually come to success, right? So in that sense, I don't imagine you have LPs from that fund sitting here going, that was great for all of us, in the same way you're sat here being able to reflect on how, if it hadn't been for that VC, you wouldn't be running this business, right? So there's also that weird tension between the ecosystem benefit over time that often is completely disconnected to the initial interest to try and place a bet and extract the value within, 7 years.
I want to make sure that I say that I think all the investors, so the investors that we had in 88 were also all friends and family. We had practically no kind of outside institutional. It was also relatively small. You can do 50 investments for $5 million, which in the VC world is not that much. But when you make very small tickets, you can do 50 investments, average ticket size, costs, operations, programs, everything for 100,000. You can do that with $5 million. So with relatively little money, we got all of it from friends and families and kind of funds that we knew through friends and families, etc. And I think all the people that are involved with 88 were very happy with the outcome of it, again, because the return on that investment is quite sizable today. But also 88 wasn't actually structured like a VC fund. It was structured a bit funny because it was set up as an investment company. So there's not like a horizon of 7 years to return the funds to the LPs, etc. It's just like we set up a company, everyone becomes an equity shareholder, and that company goes out and invests in other holdings. We also didn't really know what we were doing, I think, to be quite fair. It was kind of everyone's first stab at this kind of thing, and we were fumbling through and learning as we were going.
And that humility is helpful, right? Because without it, it would strike me, and perhaps someone else listening, that a bunch of you just went for the lowest common denominator convergence of all those thesis points and went, oh, young people getting more affluent, more disposable income, wanting to be part of the world, more connected through the internet, cheaper connectivity, digital connectivity. And you look at all those things and you think, aha, game night, Manchester United versus Man City. And exactly, that's where we're going to meet you and supply your need, Africa. So yeah, I think without that humility of we couldn't have seen how that would work, I think it's very easy to lean into that very sort of cynical view. Coming out of that, it'd be interesting to me to distill what your learnings were. And I have a hunch, but I want to hear what your learnings were that signal, right, we are killing it at this, profitable, as you've said. We're now a multinational business on the continent. Betting's never been more popular. Clearly one of the most searched terms in most African countries.
Yeah, I think you'd be surprised, though, that actually the rate of population engaged in sports betting is not really that different on the continent than it is from the rest of the world as a proportion of the population.
School me.
People think that it's a much larger part of the economies and a larger part than the social fabric than it is in the rest of the world. But the numbers don't actually support it when you look at the proportion of the population that's engaged in monthly betting compared to places like the UK or like the US or Germany.
The way I think about that, and that may be fair, I'm not au fait with all those numbers. I just think as a proxy for everyone who gets to participate economically, meaningfully on the internet, I think there's a fairly substantial share of early adopters of the internet users of a certain level of economic depth happening in Africa at this point in our trajectory relative to other countries who perhaps had time to use the computer for other things apart from betting their life savings away. So I think there are nuances there, but drilling down to what I think would be helpful for you to share is what insights from being in that business, observing the African consumer in that business, the way they're using the internet, the way they're leveraging payment rails, financial infrastructure, newfound utility and cheaper smartphones and more accessible internet. How does that translate to let's do a fintech, given the backdrop I opened with?
It's probably slightly two different questions because the path into the fintech was much more opportunistic of we have this thing that we're building in-house. Payments is one of those things where like it's very merchant agnostic, right? So we built this thing. We can easily lob on a whole lot of other merchants from a whole lot of other industries that can utilize the same infrastructure that we've built without it having any specific additional cost to us. we're seeing all these other use cases for it, all these other customers that have similar problems, that have similar issues, that need Pan-African payments to work seamlessly. Why don't we just set up a different company and then offer that service to third parties rather than just keep it to ourselves in this business? Now we service a host of all other industries. So at the core now, what PawaPay has grown into is that we have two channels of fund flows. Primarily, we're collecting funds in the different markets from various different local and Pan-African and multinational merchants. So we work with, of course, still a host of betting companies, but we also work with the big ride-hailing companies, Yango, Bolt. We work with cash transfer businesses like Give Directly. We work with DSTV and Canal Plus. We work with Jehovah's Witnesses. We work with NGOs. We work with all sorts of other businesses that need to access the mobile money infrastructure and don't have the technical resources to go and build this hodgepodge of connections and the understanding of the mobile money infrastructure to do it well at scale. And then the flow the other way, we work with IMTs, people who are sending money into the continent, remittance companies that have the flows the other way. And then the real source of what PawaPay is and where things get really difficult is actually the operational resilience of that system. It's very difficult moving money around Africa at scale for so many reasons, but it's very difficult to do in a way that is seamless for the merchant. So when you have hundreds of millions of dollars flowing in both directions from 20 odd different countries every month, you need to have a system that works really well. And that's really important if you're someone like Jehovah's Witness that's both collecting and sending money out across the continent. You really don't want to worry about, is your money lost? Did the people get their money? Did I receive my collections? Is what it says in this dashboard, is that what's actually in the bank? Like all this stuff, you just don't want to worry about. You want to worry about what it is that you do well as, whatever it is that you do.
So as a pie chart, I would hazard, and you correct me if I'm wrong, that the vast majority of your business on the one side of that split is from betting businesses, right? And then smaller shares from like maybe a growing share of new business from industries or verticals outside.
Yeah, it depends a bit on how you look at it. Obviously, betting is very small transactions. It's very high volume, but very low value. Whereas something like remittance is the opposite, right? So we have very few transactions in remittance, but the value of those transactions is really large. So it depends a bit on how you look at it.
Let's talk both. So if you're looking at it from a transaction volume perspective, what's the share of all the business you serve? And then from an actual business value, broad strokes. I know we're private business. You don't have to share anything, but educate us rather than give us, this isn't a boardroom.
If we start by looking at just number of individual merchants, we have a small handful of betting merchants and the vast majority of our merchants are non-betting merchants. If we look at the transaction value, the remittance businesses far outweigh the number of inflows from the number of outflows that we do from betting by a wide margin.
Which begs the question, why stay in betting?
So I've been involved in the betting industry for a long time. I was running around on the continent doing our interactions with regulators, with government, with tax, with marketing, with all sorts of aspects in a variety of different countries. And I'm very aware that you don't have many friends when you're in the betting industry. Like most people will throw you on the block for their own benefit. And when something goes wrong, you don't have a lot of interest groups that are willing to stick their head out to save betting. And that's fine. People can have their own moral stand about betting. And I think that's a personal preference. But what I do think is quite important for betting, and what I do think people miss sometimes of the bigger picture of betting's role in fintech in Africa is that because of the nature, again, of the betting transactions, that is very high volume and it's very frequent, it means that it's something that people use very frequently, use it often several times a week. Whereas if you pay for your electricity, you might open your MTN Money app or your M-Pesa app once a month to make an electricity transaction, and the usage is very low. So what betting does is it drives adoption like few other applications. It's kind of like the killer app for mobile money. It made people immediately use the infrastructure at a very high frequency, and then they start to understand, okay, there are all these other things I could do with it. It constantly stays top of mind. The other vector is that whether one likes betting or not, most fintechs on the continent, in one way or another, survive on betting flows, because the betting flows are, again, because of the volume and the frequency, are very high. Most fintechs on the company in one way or another touch the betting flows either directly or indirectly or through a chain of flows that goes from one PSP to another PSP. And what that does is that it allows the fintechs and it allows the PSPs, like it has done with us, to use the revenues from the betting industry to build out infrastructure that can be useful for a lot of other industries. So if we didn't have the revenues from the betting industry, we wouldn't have the infrastructure that now allows for someone like Yango to serve thousands of taxi drivers in these markets, because there simply wouldn't have been the money to invest and build this out. We wouldn't have the infrastructure that allows for the remittance companies to have this seamless access into all the wallets. So the backbone of a lot of this innovation, which is the same, by the way, in the Western world, is often like porn and gambling and like devices have been pushing the technology envelope. And that's the exact same that we've seen on the continent. Like the requirements from the betting industry, because they are so high technically, have been pushing the envelope and have been pushing the adoption at a rate that everyone else is now coming behind and benefiting from. I'd say, give or take 5 years after, all the benefits of the hard work put into getting the betting infrastructure to flow and getting the adoption up and the users and the familiarity with mobile money and the familiarity with using the phones to look up football games and understanding all the technical infrastructure around it. Those benefits are now being seen by all the other sectors that are now really picking up speed nicely.
So in other words, the next time I catch a bolt, I need to be really grateful for the betting industry.
That's a bit hyperbolic, but at the core of it, I think there's some truth somewhere in it that a lot of the infrastructure was pushed very hard by the profit motive from the betting companies and the demands on the infrastructure and the education of the mobile money product and the financial infrastructure that came behind it does have very large positive externalities that are spilling over into many other industries.
I am being slightly facetious here, but this is what it looks like, I think, to grapple on different sides of the board. And to be fair to you, and anyone who's listening for the first time might not be familiar with how open I am to fielding a range of views, even dissenting ones. However, it really doesn't change in many ways how strongly I feel about that particular industry and its impact on the continent as a net negative. But I think things can be learned regardless, right? So in the time we have left, conversationally, we've pretty much covered fundamentally what differentiates you from a broad range of players, asserting the same talking points, the same problem distillations, the same thesis statements, the same rhetoric around the need to solve for this infrastructure. I will put it to you as we sort of wind down that it's impossible to ignore how artificial a lot of those problems are in terms of like literally why they exist to begin with and why they perpetuate. The next thing I think is really interesting, given your betting background, and again, the importance of that vertical as it feeds into your business, it strikes me that you might be at an advantage in a world where I imagine many a fintech founder, come neobank aspirant, is looking at this prediction market trend and going, we need to position for that. It strikes me that you might be uniquely positioned to head into that. And then there's something we didn't touch on nearly at all, which is the whole crypto thing. I think you alluded to it as part of the framing of finance more broadly and the major sort of trends and headwinds within the space. It also strikes me, linking to the very first point I made, that in light of the very intentional and very artificial fragmentation, frictions, etc., within finance, moving money around across the world, but certainly in Africa, it strikes me that crypto, not least crypto a la stablecoin, is now widely considered a major solve to all of that. So I put all of that forward to you in the last 10 minutes or so of our conversation to invite your sense of where you're taking this business, what you're uniquely positioned to grapple with and convert as far as opportunity to build on the advantages that you already had, profitability, unlock new verticals. And if there's anything I haven't shared as a backdrop to that question that is pertinent to how you and your strategy core, your boardroom is thinking about growth and into the future in the medium to long term that you are privileged to be able to think in.
Yeah.
Let us in, man.
Let me maybe start then by talking a bit about the growth and how we see the growth and touching in on the VC side of it and where I think a lot of people get the strategy wrong on the continent. If we look back a couple of years ago when there was the last big fintech boom and people were raising money at 80x revenue multiples, like completely blown out, disproportionate to the value that's actually being created on the continent. I think one of the mistakes that a lot of businesses make in this part of the world where you have a relatively shallow financial infrastructure on the funding side is that when you don't have a lot of established follow-on funding and you don't have very deep pools of willing capital to keep companies alive, and it's just a matter of the valuation being 20% higher or 20% lower as you go through the rounds. One mistake that we saw a lot in the past is that because the continent is very early, if you raise a lot of money, what eventually happens is that you blow up your cost base with the expectation that your revenue is going to follow up. But what always happens is you don't hit your revenue targets, or you have the few blowouts that actually do. But the vast majority of times in these things, you raise some money, you build out your cost base, and you don't hit your revenue target. And then you go and you raise some more money and you continue the train down the line. But what happens here is that extra money is not that certain. So then the mistake people often make is they think like, well, I can just lower my cost again. I can just get back to where I was before. I can just dial it down. We can scale back operations and we'll get back to profitability. And this is what we've seen a lot of companies do now in the last 2 years, is trying to get to that place. But there's a really strong mistake that people make there, because you can't. When you build up your cost base, you hire people, you get good at certain things that you maybe shouldn't have gotten good at. And then when you start to peel the company away again, you
like
don't
maybe
know
gambling. I'm joking.
maybe gambling. Or I don't know. Maybe you go deep into credit cards, or maybe you go deep into some banking routes, or maybe you go deep into some kind of app feature that allows people to send money from. You don't have that hard profit-driven filter for what works and what doesn't work. So you just throw money at everything and you're like, well, I can just scale it back. But the problem is, like, when you scale back, you don't know which part of the business are the right things to take back. And we all know, like, business is people, right? You want the best people to be in your boat and build the company. And when a company starts to not go great and you start to lay off people, the great people will leave. So you get this weird thing where you think that you can overshoot and you think that you can just scale back. But in all cases that you see, especially in this part of the world where the funding isn't there to fill the gap later, you really struggle. Once you start to hit the brake, once you start to scale down and you let people go, people leave, you don't know what you're being good at, and the companies turn into these like zombie state, the businesses. So that was the growth angle from our perspective, because we've been quite fortunate with profitability. We consciously chose not to take money in the last big peak, even though people were throwing money around like crazy, because the way we look at the continent as well is we're still very early, right? Like, I think the digital infrastructure on the continent is maybe somewhere akin to the US in maybe the early mid-90s. There's so much that's still ahead of us. And there's a limit to how fast you can grow these businesses. So when you take big VC funding and you want to grow 10, 15, 20x over the next 2, 3, 4 years, there are places where that's possible. But by and large, it's a very risky strategy, because you have to grow at the pace of the general infrastructure on the continent, which is maybe 20, 30% a year, something like that. It's still very high, but it's not 500% year on year for the next 5 years. So if you take a huge amount of money in to try and blow up your revenue to 50, 60, 70, 80, $100 million from a very low base over a small amount of years to make some VCs happy, you will eventually fail. So we didn't do that. So our growth trajectory has always from the beginning been very cautious. We're looking at where is this business in 10, 15 years. So that's the kind of backdrop through which we're looking at where we're going and where we're heading. So we're building out against this core thesis of what the payments infrastructure will look like. And obviously stablecoins and crypto here is like the big joker in the room. Like, I think credit cards, I just don't believe in credit cards. I hate all the cards. I have a debit card from my Kenyan bank that I didn't renew last time it ran out, which was probably 2022 or something. I mean, every time I make an online transaction with a card that doesn't work, I curse the fact that they don't have mobile money, because I just think it's such a superior technology. So we've never been big on cards. It's just fraud and expensive.
I mean, when you say cards, are you talking about the actual form factor as the plastic?
No, I'm talking generally about the underlying infrastructure.
Does that include in your mind like integration to Apple Pay, Google Pay, all the ways, like in my app, for example, I can have as many cards as I want now. I can create new ones. Are you talking about that whole stack?
I'm talking about that whole stack. One is that it's messy for the consumer, but that's to some extent being ameliorated by the Apple Pays and these kind of things. But the underlying infrastructure behind the card is just so hugely messy. The whole settlement infrastructure, the complicated schemes, the fraud around it, it's hugely messy, hugely expensive. And today, where everyone is online all the time, hugely unnecessary. But crypto is an interesting player. And I was just at a virtual asset regulating conference here in Cape Town yesterday morning with an update on what's going on the continent from the regulator's perspective on crypto. And it is really interesting because ultimately, what stablecoin solves is the third-party trust issue, that you constantly have to have somebody verifying that the money is there when you're making a transaction between two parties. That's the kind of role of the banks.
That's why I was asking the distinction about the card form factor versus the system, because it is a proxy in many instances for that trust. As someone who travels broadly, like making sure you book your flight tickets using your credit card versus your debit card or your car rental, whatever, just because of all the free insurances that kick in and the assurance it gives all these other third parties that you're bankable.
It's not free, man. It's not free. Somebody's paying for it, and that's ultimately you.
I'm saying free because, again, I'm very well versed in just how much fraud that system absorbs as a feature, not a bug, of the system, and how it masks that cost to the rest of us and really just spreads it out in ways where we don't even recognize that it's a cost to us. So I'm very well aware of that. I just wanted to be very specific in understanding how you see that. You're saying that entire system is just not helpfully delivering on the utility of trust in a way that, say, stablecoins would.
Yeah, at the core of it, what distributed ledgers promise is the fact that you and I can make a transaction and we don't need anyone else to verify that I have the money or verify that you got the money. It is distributed in the cloud. It's in the ledger. There is no need for third-party verification. Any other type of transaction that we do today, you need an intermediary bank to verify that I actually have the money on my account, and then they need to communicate to your bank that the money has actually moved, whether you do that through a card or whether you do that through mobile money or an EFT or whatever.
Visa and MasterCard say, why bother with that, Nikolai? That's what you got MasterCard for. But you require
someone else to be involved in that transaction, and distributed ledgers and stablecoin remove that entirely. So ultimately, it just is a much better, much more efficient way of moving transactions around, which is why I think ultimately this technology will win. The question is how. And if you look at it in the African context, there's a quite interesting kind of dance going on right now where the adoption is quite high. There's a huge need for it, mostly around currency controls and currency restrictions and currency shortages. That's where the real benefit of these stablecoins come in. There's a lot of uses for cross-border transactions and stablecoins. Most people who move money across borders on the continent now, in one way or another, use stablecoin at some part of their flow because it's a way to get around the currency shortages. But the issue that I think I see is that while we're taking some nice big strides forward right now with regulation coming out in Kenya and Ghana and Rwanda lately and Nigeria, etc., the problem is when you open up the faucet for stablecoins and allow people to transact in and out of USDC or USDT or whatever, like stablecoin, whatever hard currency stablecoin that you pick from local currency, what happens is that the central bank gives up the control of the currency because they can no longer control the flow of the funds. And they're just now in this period where they're starting to discover, okay, what kind of impact does this have on the currency? What does it mean if we allow people to do this? And what I fear is, while it would be greatly beneficial for everyone to have full access to stablecoins and it will allow a lot more trade, a lot more fluent trade, what would ultimately happen is that it will further put pressure on the currencies that are artificially being held up right now, and it will lessen the tools the central banks have to keep them in place. And if that starts to roll and the central banks start to discover this, I think they will take one or two steps back and they will start to really clamp down on it. What you've seen here in South Africa is a pretty good example. So South Africa has currency controls, for those who don't know it. There's a limit to how much money you can take out of the country if you are South African. They legalized or legislated, regulated, whatever word you want to use, crypto and stable coins. But because it was classified as an asset, not a currency, it didn't fall under the currency controls. So people could take as much money as they wanted out of the country using crypto. It took about a year and a half for the regulators to realize what was happening. And now they're trying to plug that hole by saying, actually, crypto is a capital asset and it falls under the same controls as crypto. So I think you'll see a similar dance in the other countries around stablecoin adoption and stablecoin usage. So I'm a little bit cautious of being super optimistic of the all-out adoption.
Can I just point out the obvious self-interest in your stable coins could arguably be one of the most disruptive technologies for your business as it currently stands, correct?
Oh, absolutely. 100%. But I'm all for that. We already have a stablecoin product, so merchants can use stablecoin to pay with PawaPay as well. For us, the core mission is I want to help businesses transact on the continent. I want to help businesses flourish. I want to help entrepreneurs who want to build and scale businesses on the continent be able to do that, whether they use cards or mobile money or crypto. Like, that's irrelevant for me. I don't believe in cards, but if that was the case, we would do cards. So I don't care if it's mobile money or crypto or banks or EFTs or whatever. I really hope it's crypto because I think it's a superior technology. I'm just cautious of how much I'm going to bet the company's immediate future on it happening in the next 2 or 3 years. 10, 15 years, probably more so.
Gotcha. But then I think it's also fair to say, if I were to set aside, which I can't, my aversion for gambling for a second, given the dynamics of what I know will be true in another 10, 15 years, for sure, Africans will be gambling.
Yeah, I mean, there's nothing anywhere in the world that points to people suddenly stopping gambling when they get more affluent. So I think that's a pretty safe bet. I think if you look at the trends that are happening in the rest of the world, it's probably more likely that it's going to be more and more. But also I think you got to be a little bit more fair with it because it's like gambling in a certain way has a certain reputation. But if you put money in the stock market, in absolutely many ways, that's entirely gambling too. You have no idea whether the price is going to go up or down tomorrow. But that's considered like a sensible way of people to gamble with their money. And I think the trends that you're seeing now with the prediction markets rolling out across the continent, like this kind of many different ways that people can bet or gamble, invest or play with their money in these different ways is proliferating rather than being rolled back. So I don't think there's a largely different path forward for the continent either.
I will grant that, Nikolai, in part because I actually have a very high bar for what constitutes investment over speculation, gambling versus measured risk-taking. And I think those distinctions aren't debated often enough. I should probably have you back to have a whole conversation about that specifically, because I think someone on the other side of that spectrum, I sense, would be an interesting thing. So I will grant that. My closing salvo on that point would be to anyone listening who is in a privileged position, because anyone listening to this podcast is somewhat privileged, not even somewhat privileged, easily, especially if they're on the continent, easily a part of the most privileged early adoption core of digital transformation on the continent. And if you're listening to me and a lazy proponent of, I don't know, online betting as net positive for the continent, I would encourage that you have a much more nuanced view of what that might mean, given our very specific trajectory and the nature and specifics of our dynamics on the African continent. And so I say that knowing full well that policymakers listen, and also being a proponent of freedoms that I hope are respected. And I've had some of my views leveraged to try and make a case, for example, for blanket bans on gambling, etc. I'm not on that side either. So I just think having a nuanced, studied and educated sense of what those things are, and then applying a moral lens to it at a personal level, which I think people should be free to do, is what I espouse. I think you've been an excellent sport for fielding my obvious aversion for it. But I think everyone listening is the better for it.
Can I ask, I'm curious, what do you think the average active bettor spends on sports betting a month?
I have no idea.
It's a couple of dollars. It's 1 or 2 beers.
Okay, so let me tell you where I come from in terms of this conversation. So the area I feel most strongly about, funnily enough, within digital transformation is the gamification of being online. So if you go back to the earliest scene of the crime would have been Facebook's assertion of internet.org as net positive for anyone who doesn't have the internet, and then proposing that Facebook should curate the only version of the internet that most Africans will see for free, because isn't that a right? So my assertions around gambling, but within the context of our digital transformation and tech ecosystem and startup ecosystem, actually don't even start with baseline aversion to gambling, which I suppose predates all of that, because I just gambling, whether it's lotteries or whatever, none of it. I wouldn't take grants from a lottery, for example. We wouldn't. But that's not even where it starts. For me, it's going at the heart of where we lag as a continent. The biggest gaps and the most fundamental gaps in the medium to long term are at the point of human potential. And the role of online gaming / sports betting / whatever people want to call it, even prediction markets as a proxy for sanitized betting and mainstreaming these behaviors in ways that we don't even have enough Africans exploring what a healthy investment outlook looks like in investing in stocks, for example, right? And yes, for most of us, without the right guidance, that would constitute gambling as well. We haven't even solved that problem, and we've got prediction markets rolling into South Africa via Luno, as an example, right? And I'm like, great for them. If it was my job to spin why this is net positive for society, I could certainly do it with aplomb. But that's, in my view, certain things really just attacking our richest resource, which is human potential, and the building of discernment at that level. So I'm naming all the places where that lens can be applied. That isn't necessarily sports betting or online betting, because this isn't me inviting you here for a moral bashing. It's just going, for anyone listening, hey, I think one of the things that are also true is 10 to 15 years from now, people will be looking to buy other people for the joy of having sexual activity with them on a paid basis. That's going to be a thing in another sort of 10, 15 years from now. And if you're a smart betting person with no scruples, I suppose that's a business you should be into. So I'm just saying it's really more about not telling you what to do with your money, or even creating an environment where you aren't free to do what you will with your money within legal bounds. It's just going, this podcast exists for people to have nuanced perspectives of what the implications are. If you decide, for example, the only internet you need in your life is TikTok, and making a life trying to be the next Mr. Beast or Kabilame is a worthwhile endeavor over, I don't know, starting a business or even like a career in a traditional industry, like something boring, like, I don't know, agro or whatever. So I think they're just young people who listen and who advise through my advisory, through this university and other places where it's like a lot of these things actually need saying in ways that are not intuitive to those of us who've already synthesized them through our own advanced lenses. You and I are probably 2 decades into our careers. I'm talking to some young people who are making a decision to bet a few bucks on the strength of, hey, why not? What's it to me? And maybe before you make that a part of your life every day, understand what else is being reprogrammed in you and what the opportunity cost might be.
Yeah, I would obviously